Good morning, ladies and gentlemen, and welcome to Lietuvos bankas. It may just seem that today is just an ordinary Tuesday. Actually, it is not. We are meeting on the eve of a day of the restoration of Lithuania's independence, and that gives our discussion this very, very special resonance. It reminds us that economic resilience ultimately depends on the freedom to choose our own future. And on a day like this, it's a particular honor and pleasure to host people who don't just observe the economy from the sidelines, but actively shape it through their decisions in investment, security, and finance. And I'm especially pleased that Mr. Edward Lucas is here with us today, because it was his curious and incisive questions that inspired the very idea of holding this discussion. Mr. Edward helps international audiences understand that the Baltic region is far from distant periphery. In fact, or rather, it is a dynamic and, in geopolitical terms, strategically significant region, one that shows how states can adapt and thrive even under the turbulences of the 21st century. Dear guests, resilience is often discussed as a policy objective, but here in Lithuania is actually lived experience. Situated at the crossroads of empires and repeatedly forced to rebuild statehood, Lithuania developed a strategic mindset shaped by adaptability, self-reliance, and pragmatism. Economic resilience here reflects not only political and policy choices, but historical memory, the understanding that stability cannot be taken for granted. It must be continuously built. For a small and open economy, stability depends not only on domestic discipline, but on being firmly embedded in a wider framework of rules, markets, and shared commitments. European economic and monetary integration strengthens credibility, reduces uncertainty, and lowers structural risks that come from geography. And here is another moment that is perfectly in tune with today's discussion. Today, Bank of Lithuania issues a commemorative coin dedicated to Lithuania's energy independence, marking disconnection from Russian energy supplies and freed ourselves from a constant pressure of energy weaponization. This moment is symbolic, but it also carries a deeper message. Independence is not only a political declaration. It becomes real when it is reinforced by concrete economic choices, and energy independence is one of such choice. Lithuania's disengagement from Russian energy, together with many other strategic decisions taken over many years, has therefore been born transformative. It strengthened our resilience while we also making the country more predictable and secure place for long-term economic growth and activity. Investors themselves confirm this with their action, and despite geopolitical tensions, they continue to invest and expand the activities in our region. Shortly, my colleague Kotryna will present a broad overview, but let me highlight just a few facts about a country I know best. So, since 2019, total investment in Lithuania has increased by around 40%, one of the strongest performances in the EU. Since February 2022, the investment to GDP ratio has remained around 23%, close to historical highs. Foreign direct investment has averaged about 4% of GDP between 2022 and 2025, nearly double the pre-pandemic decade average. A significant share of investments come from companies already operating in Lithuania, expanding their footprint, a strong signal of sustained confidence. Since 2022, Lithuania has attracted hundreds of new investors. Yes, pace of newcomers has slowed. Yes, this is partly related to our geographic location and broader geopolitical environment. However, there is another often overlooked factor: our structural transformation toward a higher value-added economy where larger projects require longer preparation but promise higher long-term returns. So, sky is not falling. This brings us to the central question of today's discussion: not whether, but why investors come or stay, and the faith behind investment. We seek answers to better understand our competitive advantages and, equally importantly, to openly identify areas requiring improvement. Insights from distinguished business practitioners will help diagnose these challenges. And as the day draws to a close, hopefully crown the discussion with practical ideas to strengthen investor confidence further. So, dear guests, as John Maynard Keynes observed or said once, investment is an act of faith in the future. I don't know if I can improve it, but I will add something on this. Investments are also decisions grounded in data, experiences, and institutional quality. So it's not just a blind faith, it's rationally calculated courage. In recent years, Lithuania and its neighbors have often been described as frontline states. I believe investors, however, navigate by different coordinates, evaluating institutional credibility, regulatory stability, timeliness and speed of decision-making, and the quality of risk management, meaning the ability to anticipate shocks, respond decisively, and maintain stability, even under pressure. So I'm really looking forward to hearing about this straight from the source, from the investors themselves. My own sense is that investors value a region's maturity and resilience. And by resilience, I mean the ability to remain focused on strategic objectives while adapting flexibly when circumstances change. Living close to geopolitical fault lines is undoubtedly a challenge. And yet, over time, it also creates an advantage. Operating in a risk-intensive environment forces institutions, businesses, and society to become better at recognizing, managing, and preparing for risks. And for this reason, investment here is not driven by ignorance of risk, but by understanding them. Energy independence is a clear example. What began as a response to geopolitical pressure has evolved into a structural transformation, strengthening resilience while at the same time opening a major field for investment and long-term economic development. For private capital, risk is inherent to every business, every project. Investors do not shy away from risk, but they do avoid uncertainty and opacity. Therefore, the role of the state, strategic consistency, and predictability remain critical pillars of confidence. What can and must we do to ensure this confidence remains strong? How can we attract new investment flows while ensuring investors are satisfied with their choice to invest in this region? And I hope today's exchange will be intellectually challenging, strategically forward-looking, and practically grounded. So we are not here to celebrate success uncritically. And nor we are here to catalog somehow risks pessimistically. I think we are here to understand how this region can continue to justify investors' faith, not only today, but also decades ahead. So thanks to everyone for joining us. And now let's try to move from monologue on narrative to evidence-based presentation. And I invite my colleague, Mrs. Kotryna Tamoševičienė, who is Director of the Economics Department at the Bank of Lithuania, to present much much broader picture.
Thank you very much, Governor. Good morning, everyone. So, yeah, the recent years have been full of challenges for our region. But as the governor already illustrated it so nicely, we are used to challenges in this region, and we deal with challenges. And so today, let's take a look at the economic data and see what they tell us about the last 4 years in this region. So when the Russian aggression in Ukraine began in 2022, the consequences for the neighboring region were immediate. And this picture is from a campaign run in the UK with the purpose to encourage to support Ukraine. But it also captures another perspective. It shows for many people, both in the region and also elsewhere, the question crossed their minds, what if we are next? And that challenged something really fundamental: confidence. The confidence which in economic terms decides the economic behavior, like consumption and investment choices. And at the same time, besides the confidence shock, at the same time, some very direct economic shocks hit the region's economy. So let's first take a look at those shocks. Probably the most painful one was the surge in energy prices. And electricity and gas prices increased dramatically across the markets, pushing inflation throughout entire European Union up to, on average, 10%. But as you can see in the chart on the right, the Baltic countries experienced a much higher inflation. So in Estonia, in Lithuania, inflation rates reached even 20%. Why was that the case? Well, we have a different energy intensity, slightly maybe lower energy efficiency, and also various other factors related to our economic structure, industrial structure, or energy sector structure. Another immediate development was the movement of migrants from Ukraine. Of course, the neighboring Baltic region was naturally seen as a safe and welcoming destination for those people. And of course, the countries in the region were very willing to help. But in practice, many solutions had to be found. So programs had to be established, resources had to be allocated, legal frameworks had to be adjusted. And in Lithuania, the number of incoming foreign migrants exceeded 100,000 people in a couple of years. And that equals roughly the population of mid-sized city in Lithuania. And that is far above anything previously historically seen in Lithuania. Trade was another area heavily disrupted by the war. Because of this geographical proximity, Lithuania and other countries in the region had significant trade flows with Russia, Belarus, Ukraine, and we sometimes used to say that we are like a bridge between East and West. Sounds nice, but as with many bridges, the day came for those bridges to be burned. And trade flows stopped on one hand because of the sanctions, but also because of decisions by businesses based on their values to willingly retreat from those markets, and sometimes not without the pressure from the society. The overall share of exports to Russia or Belarus was already declining since 2014, the previous invasion of Russia to Ukraine. But some sectors were still heavily relying on these markets. For example, in the case of Lithuania, the railway cargo was basing a lot of their business activity on transporting the fertilizers from Belarus to the ports of the Baltic Sea. Also, in case of Estonia and Lithuania, there were some sectors very reliant on raw materials from Russia or Belarus. And replacing them meant turning to significantly more expensive alternatives. And then there was, of course, the shaken confidence, which in economic data appears as increased uncertainty. So confidence indicators, again, they declined across the European Union. But the fall in economic sentiment, in industrial confidence, it was much sharper in the Baltic region. Interestingly, consumer confidence did not decline as sharp as in European Union, perhaps due to strong wage growth and other positive factors within our markets. But in general, I even remember having conversations with friends and wondering whether they should postpone buying a home here or whether they should spend their savings investing into real estate somewhere further away, like in Spain and so on. So it really felt like a moment where people questioned, should I stay or should I go? Like in a song, right? And so what happened? What happened next? How did the Baltic region react to all these economic shocks? And since I already started quoting songs, there is another one which goes, you know, did you think I'd crumble? Did you think the Baltic region lay down and die? So the answer of the Baltic region was strong, I will survive. And I would say, in fact, it did more than just survive. If we look at the real GDP growth, we see that it was, in comparison, given the environment, it was strong economic growth. So over the 4-year period, the GDP growth in the Baltic region was more than 8%, compared to European average, which was close to 5%. Trade. Lithuanian exporters once again demonstrated their ability to adapt, which we have seen already in many previous crises as well. Trade with Russia declined by 90%. And exporters successfully redirected their flow of goods to other markets. Mostly that was within Europe. As a result, total Lithuanian exports actually increased by 7% over the 4-year period. Energy costs, as I mentioned earlier, had really painful consequences for the region, pushing up the inflation and pushing up the costs for businesses and also for households. Of course, the governments, as in other European countries, they introduced some schemes to diminish that impact, to subsidize businesses. But these shocks also became a powerful motivation to accelerate investment in energy sector and to strengthen our energy independence. So between 2022 and 2024, investment in the energy sector grew by more than 25%. You see this large green column. And these investment were directed to renewable energy generation, also to energy storage capacity, and expansion of electricity networks. And as a result, electricity generation from renewable sources increased 4 times over the 4 years, and the total energy production doubled over these 4 years. Also, at the same time, Lithuania continued doing other steps to increase our energy independence. So we disconnected from an electricity grid with Belarus. We strengthened our connections with Poland. And also today, Lithuania is importing 0 Russian oil or gas. The production of electricity is increasing every year, and we hope it will be soon sufficient to satisfy all the needs for electricity energy in Lithuania. Support for refugees, it also translated into economic participation. So many Ukrainians not only found safety in our region, but also joined the labor market. For example, in 2022, around 60,000 of Ukrainians were employed in Lithuania. So, and what about that fear? What about that fear of geographic proximity and that it might discourage investment? Once again, the big picture is surprisingly positive. So real investment in the Baltic region increased by nearly 9% over 4 years. And that compares with only around 3% growth in the euro area as a whole. In Lithuania, the numbers were even more impressive. Real investment increased by almost 25% during this period. And now going into details, after the start of the war, private non-housing investment actually stagnated. And in this period between 2022 and 2024, investment growth in Lithuania was mainly driven by this investment into energy sector and public sector investment. But what is positive that in 2025, we already see a strong recovery in investment growth, both in private sector and public sector. And of course, the situation differs across countries. We see in Estonia and Finland, the trends were weaker, but also these developments are influenced by various country-specific factors. And I hope we will have a chance to talk in our panel discussions about those different stories among the countries. Now, foreign investors, of course, were affected again by this heightened perception of risk in our region. And attracting new investors became more challenging. Again, we will have many panelists who can tell their stories directly about foreign direct investment in the region. But let's see, what do the data tell us about the case of Lithuania? So after a really strong upswing during the pandemic, when foreign direct investment reached 6% of GDP, inflows moderated to just below 4% in the following years. However, it is important to see it in the perspective, right? So even this lower 4% level, it remains almost twice the level which was seen pre-pandemic. And most of the investment have been driven by the companies that are already operating in the market. And it shows that they decide to stay and they decide to expand their activities. The number of entirely new investment projects has declined. But at the same time, it is also encouraging to see that even equity investment, so apart from reinvestment, it remained broadly close to the pre-pandemic levels. So in general, even if it is more difficult to attract new investors, existing investors have largely stayed and continued to expand their activity in those markets. Now, commercial real estate is another area where the should I stay or should I go question appeared. And looking at the Lithuanian data, investment activity declined, but interestingly, prices told a different story. So both transaction prices and rental prices remained relatively stable, and recently, as the interest rates became better, they have even started to move upward again. And also vacancy rates increased up to nearly 10%, but again, stayed below the levels which would mean significant stress in the market. And 2025, again, signifies a clearly start of a recovery phase. So the number of purchase transactions, for example, increased in the last quarter of 2025 by 30% in year-on-year terms. And another interesting development in this area is the changing structure of financing. It seems like real estate funds, they have become significantly more reliant on domestic capital. So if the share of locally sourced funding was nearly 60% in 2020, today it is almost 90%. Okay, now the housing sector, which seems to be proved to be much more resilient to those geopolitical tensions. So if we look at housing transactions in 2022, the trend did not deviate dramatically from any historical averages, despite the heightened uncertainty and this anecdotal evidence which I mentioned earlier. And more recently, as borrowing costs began to decline, we really see activity in the housing market accelerating. So by the fourth quarter of 2025, the number of housing transactions already exceeded the long-term averages. So it seems like households, again, demonstrated confidence in staying here, in creating their future here. And of course, we do buy quite several apartments in Spain, but that is not to escape the geopolitical tensions, but rather the cold Lithuanian winters. Yeah, and another important process which was triggered by the war in Ukraine was a major increase in the focus of our government to increase the defense investment. Naturally, that contributes also to the total numbers of investment, but its importance goes beyond these numbers. Because for Lithuania and other Baltic countries, the defense investment sends a very clear signal that we are committed. We are committed to ensure that this region stays safe and secure. And in that sense, defense spending is also about supporting confidence, right? So this confidence which underpins the investment decisions across all the other sectors. Like with Professor Bumelis, we were discussing yesterday, like, what is more important, to invest into military jets or to invest into biotech industry? And we thought maybe the jets is the precondition for developing your biotech industry. And at the same time, the region is also working to developing our own defense industry. So the goal is not only to strengthen security, but also to ensure that the larger share of the defense spending goes to support local economy and builds domestic capabilities. So in this area, actually, the proximity to Ukraine proved to have unexpected advantage because our defense industry, working with their partners in Ukraine, have the possibility to get very, very fast testing and feedback directly from the battlefield conditions. And that enables innovation process to move more rapidly than it would be given other circumstances. So, if we look back at the question of confidence and what challenge it posed to the Baltic region, the economic data give a very clear answer. So the Baltic region did not retreat from uncertainty. It invested, it adapted, and strengthened its economic foundations. And the decisions in defense sector, in energy sector, motivated by this outside threat, they are strengthening the resilience of the economy. And at the same time, the adaptability and openness of our small economies once again helped us to withstand those rapid challenges in the global environment. And, and that may be like the most important message of the last 4 years, that resilience is not just about surviving the shocks, but it is about turning them into a possibility to become stronger and turning the pressure into progress. And looking through the window at the global landscape today, we can be pretty sure that further challenges are behind the corner waiting for us. So the experience of dealing with challenges of the Baltic region might prove to be very, very useful in the upcoming years as well. So with this, I will end my introduction, and now I'm very happy to invite our brilliant moderator. So please welcome Mr. David Barwick, who kindly agreed to lead us today further through our event. Thank you.
Now it's on. Thanks. I'd like to start by thanking the Bank of Lithuania for inviting me to participate, and I'd like to invite the participants in the first panel to join me on stage. So starting at my far right, we have Madis Müller, the governor of Eesti Pank, Estonia's central bank, who brings both central banking and international financial institution experience to questions of economic resilience and stability. Next, we have Governor Gediminas Šimkus of the Bank of Lithuania, who gave some opening remarks already, thank you for that, and who has spent more than 2 decades working across many areas of central banking. And next, we're joined by Laura Solanko, the deputy head of the Bank of Finland's in-house think tank, BOFIT, where her work focuses on Russia's economy, sanctions, and the regional economic outlook. And finally, our fourth panelist is Edward Lucas, an international journalist and security expert focused on Central and Eastern Europe, transatlantic relations, hybrid threats, and who is a longtime observer of the Baltic region. So as someone who comes to the Baltics regularly, I sometimes catch myself thinking about how geography enters decisions here in ways people farther west may easily underestimate. If you're considering starting a business or even just buying an apartment, how much does proximity to geopolitical threat matter, and in what ways? We're going to explore those questions now, and in particular the relationship between security, economic resilience, and investor confidence. I'd like to launch this with a question that frames the entire discussion. Is economic stability at Europe's frontier a byproduct of security guarantees or a strategic asset that itself strengthens deterrence? In other words, does prosperity follow security, or can credible economic resilience create security? Who of our panelists would like to have a go at this first? Looks like you're selected.
Well, I think if you look back at the early 90s and imagine how things could have gone differently, it's conceivable, although unlikely, that the Baltic states would have ended up as a kind of Moldova, outside the EU, outside NATO, with Russian sort of dominated enclaves and constant geopolitical uncertainty. And it's a really good thing that didn't happen here. And it's really sad that Moldova didn't get on that train in the early 90s that leads to where the Baltic states are now. So I think it helps enormously to be able to say, as the sort of in the bullet point, there's a bullet point called geopolitics, and people want to know the basics. And if you just say EU and NATO members, British, French, American and Polish, German as well, military forces all based there, then you can move on very quickly. And I think if you look at countries like Israel and South Korea, you can see that living in a difficult geopolitical neighborhood is no barrier to strong economic growth and strong institutional performance. So it is chicken and egg. If you have an economic collapse, it will certainly affect your security. But being in those fundamentally, those sort of basic, and I mean that literally, institutional alliances of the EU and NATO creates the framework in which you can then get on and build your economic prosperity.
Good morning. First of all, thank you very much for inviting me. It's a pleasure to be here. But now, to address your question real quick, so what comes first, prosperity or economic success? I think it really, well, at the end, it probably goes both ways. So you cannot really have the economic success in our region without having the security conditions in place. But at the same time, I think also, given the neighborhood where we are in, and we cannot, of course, pick our neighbors, the fact that, well, the way I look at it is that that also having your own sort of economic and financial house in order, this by itself is also an important strength, and that's something that is also partly behind the sort of the stronger security situation. So we don't have the luxury of being too loose in our financial policies with the fiscal matters, because we need to have the additional buffers and the additional strength also because of the neighborhood that we find ourselves in. But it goes both ways.
Probably I will fall into the same camp, saying that security and economic prosperity or economic growth is we are in a way of a reinforcing cycle, because the modern economy is such a complex thing that this like typical or dominant line of thinking, security first and then economics, it's in a way has this linear relationship. It doesn't hold in real world. The other thing is that Mr. Edward Lucas mentioned several countries, but I think it's important also to think what's the difference, or what are the different factors that makes these countries different. And I think there are plenty of them, such as integration into the European or worldwide economy, and or having various memberships in important organizations such as NATO, for instance. The other thing is that strength and quality of institutions, level of economic standards, and many other things. And these are the factors that comes from the field of economics, which, as Mr. Edward Lucas already pointed, makes countries which are at a frontier and are under certain tensions or pressures or deal with the geopolitical risks, but also we are very different in terms of the level of security.
If I may, yeah. Thank you, and thank you for the invitation. Being the last one to pick up the question, I have the benefit of sort of building on what you said. Now, I do think that we all agree that there's the prosperity and security nexus. Security is not a sufficient precondition for economic prosperity. That's
That's clear. But then, very much echoing on both governors, it's good to remember that security is not only about absence of war. Security is a much wider issue. First and foremost, it's about institutions. It's about quality of institutions. It's about the broad investment environment the countries can offer. And there, of course, having anchors to, for example, EU and OECD and the rest of the Western alphabet soup has been and still is one sort of important anchor also going forward. Thank you.
Thank you. This brings us to an apparent paradox in terms of risk pricing. And as we just saw in the presentation, markets continue to invest in the Baltic region despite the proximity to geopolitical risk. Does that mean that investors are underpricing tail risks, or have they simply learned to distinguish noise from structural threat better than perhaps policymakers? Who would like to take a stab at that? Governor?
Yeah, so I think this is a very interesting question, and then thinking about it, it's important to distinguish between, let's put it like this, headline volatility and structural vulnerability. So, of course, various geopolitical tensions and events, they create a lot of media attention, a lot of headline volatility, let's put it like this. But when it comes to, when it boils to investment and to real decisions, right? So what matters, this is the economics, fiscal things, macroprudential frameworks and all that. So, and then it comes to the Baltic countries or Baltic region. So I'm sure that investors see the membership in NATO, deep integration in the European Union, rapid energy decoupling from Russia, disciplined fiscal, macroeconomic, as I said, fiscal, financial stability frameworks. And this is the factors that suggest that while region lives close, with a close proximity to geopolitical tensions, but it's not structurally fragile. The other thing is that, and from the investor perspective, or from the outside perspective, I think it's also important to note that we are not, or I'm sure we are not seen as a kind of a isolated periphery, but it's rather part of the Euro-Atlantic system. And then we have policymakers and we have investors. So when it comes to policymakers, as the central bankers too, we are dealing with the worst case scenarios and they talk about them, right? And but when it comes to the investors, they are pricing risks, they are pricing probabilities. And after the excellent presentation by Katrina, when we've seen that, in particular, for instance, Lithuania, when we had this rapid growth of investments and keeping at the almost record high levels, I think it's the best expression, or the best vote by investors, because investors vote with the money, how they see the region.
Maybe just to add a little bit also of the Estonian experience. So I was looking at the presentation before our panel, and indeed there's some divergence in also how the countries in the Baltic regions have fared in the last couple of years. So in Estonia we have had a few more difficult years, but this really doesn't have to do with the war or the being next to Russia. It's just that our export markets have been different. We're more geared towards exporting to Scandinavia, and they have had a relatively more difficult time than, say, Poland and the rest of Europe. But then again, we also see that the investments in Estonia are continuing. They haven't grown quite the same way, perhaps, as in Lithuania in a couple of last years, but still they're more or less stable. We see that the more high value-added services, for example, continue to grow throughout also those more difficult years. And now also the industry and manufacturing is again picking up. So things are going sort of okay. And indeed, as Gediminas said, I think investors, perhaps they were frightened in 2022 by those headlines that we also saw in the on the first slide of the presentation. But now, when you look at it calmly, then we have, in terms of the security situation, NATO having enlarged in the region, so, and also in economic terms, the benefits that we get from euro, from the close integration in Europe in every possible way, it really is giving us a lot of benefits. This is our strength that I think also investors realize. So when you look at also the way that investors are pricing risks when investing in our government bonds, the spreads between the German, that is the benchmark for Europe, government bond yields, and that of the Baltics, it really has narrowed since 22. So there was a bit of a widening at first. Now the interest rate that our governments pay on their long-term debt is actually a little bit lower than what France pays, for example. They have their own problems, of course, but it just shows that I think investors have also faith in the region.
Mr. Lucas.
Yeah. I think this is the single most important fact that everyone should take away. What the governor of the Estonian bank, Madis Müller, just said. The B3 are borrowing at the same rate as France. Just let that sink in for a moment. France is a G7 country. It was occupied for 5 years. It's been on the map for 1,000 years. Lithuania came back on the map of the world in 1991 after being occupied for 50 years. That's an astonishing difference. And I think it shows that the debt markets are pricing geopolitical risk much better than you would guess from looking at what my journalistic colleagues write. And if you read the international media, you'll see again and again stories saying Narva is next, or the Suwałki Gap, so-called, should actually be the Suwałki-Alytus corridor. Anyone here from Alytus? We don't forget you. The Suwałki Gap is the most dangerous place in Europe, or I think even the most dangerous place in the world. And so we see these extremely alarmist, scaremongering stories from newspapers, also from think tanks and elsewhere. A German newspaper did a war game in which Lithuania was occupied within a day and nobody did anything about it. And that is there's a complete mismatch between that perception of, quote, tiny ex-Soviet Baltic republics trembling in Russia's shadow, end quote, and what the financial markets are saying and what the direct investors are saying, which is this is a place that we can safely lend money to, and this is a place that we can safely invest money in.
Mr. Lanka.
Yeah, thank you. That's actually an excellent point, and sort of in contrasting how financial markets price risks in the region, and then contrasting that with sort of the general media narrative, which is ever since the seminal paper by Jacovilla and Caldara on geopolitical risk and building the indices based on news in Anglosphere media, mind that, sort of do tend to tell a bit of a different story. At the Bank of Finland, we've been trying hard and we're close to having it ready and trying to build a geopolitical index based on Finnish language media sources only, which has been a very useful exercise in that even if sort of using the very same criteria than the global indices use for building the narrative index, based on the local language media, the the outcomes are strikingly different. So even if geopolitical risk is global as a phenomenon, perceptions are local. And the local perceptions can actually differ a whole lot on what the global indices tell. And that's sort of that's clearly the case for Finland, and the risk perception based on Finnish media, and I'm fully convinced that the similar result would be based on other local language medias of the region. And that's something it's too often overlooked. The risks are local, and we just simply are living in a world where risk perceptions do have very large cross-country variation. Risks do, for some reason, apparently seem much larger when seen from further away. And that's the world we live in, and that's maybe something we need to try to communicate, that actually the real risks are local, and the local risk perception is probably what should matter more. Thank you.
So it would be fair to say that domestic investors are structurally more resilient precisely because they possess informational, cultural, and institutional proximity. Is that something our panelists agree with?
Yes, I think that's what you just said about if my Finnish was better, I would base all my decisions on reading the Finnish media.
Can I comment on this?
Sure. Your Finnish.
Yes. My Finnish is better than yours, but not perfect. I think actually, well, this is what we're seeing also now in Estonia, that local investors now have increasing confidence. There have been some foreign investors who want to sell some projects, and then we have the local people stepping in, even if it's not really showing sort of a wider shift in terms of foreigners leaving. But the point I just wanted to make is that I think it can actually go both ways. So I remember 2008 or so, I was actually not living in Estonia, but I was following the local news, and I felt there was too much optimism and a feeling that everything that's happening around us doesn't really affect Estonia too much. This turned out to be not true. So sometimes you can live in your little bubble, but in other times, and I think this really happens more frequently, is that people, investors from far away, that they don't really understand all the local conditions, and they overreact to certain developments. And I also remember very well the case where, again, it was in 2009-10, I suppose, where there were questions whether Estonia is able to maintain the peg to euro because of the pressure that our economy was under. And there were foreigners speculating against our currency, while there were many local investors that I know who understood also the political dynamics and realized that it's also almost impossible for us to change the system that we have. And they've made good profits betting against those foreigners. So I think it is important to understand the local dynamics and not to overreact to some things happening outside your borders also.
It's a very good maxim in investment, is to be greedy when others are fearful and be fearful when others are greedy. You just have to make sure you choose the right others. And but I think you're absolutely, the outside world's sort of economic commentators have been quite wrong in the past. There was a widespread assumption in the 25 years ago that the enormous current account deficits in the Baltics were a sign of an impending crash, and that was quite wrong. And I remember The Economist having a blazing argument with my colleague who said it's totally impossible for a country the size of Estonia or Lithuania to have a 25% of GDP current account deficit. And I said, well, you should go there and look and see why it's happening. And I did, and in the end the article was never published.
If I may add on this, so what you've said, Laura, and how debates is spinning. So actually, Katrina had a very interesting chat which showed the foreign direct investment to GDP over years, and now the story is that now it's at 4%. It's twice the level of pre-pandemic pre-pandemic level, but actually it's lower than it used to be from 2020 to 2022. And there was a big debate in Lithuanian, let's say, among economists and mass media, why it is so, and are we losing foreign direct investments? The other thing is that now the lion's share in these foreign direct investments are reinvestments. So this is the businesses which already invested in the country, so they express their faith into the economy and the confidence in the economy, and they reinvest. It was interesting to observe the discussion that somehow this was perceived that this is somehow worse than new investors coming, right? Maybe new investors, of course, they evaluate, they read the headlines, and we are living there, or we are neighboring Russia and Belarus, so that's true. And maybe someone is scared, so it may happen so. But what the investors, also domestic investors, and in the second panel, we'll have domestic investors discussing, and probably they will express the views and what they think. But what you, Laura, said, that the way of what the domestic investors see and how they evaluate risk, I think this is the most important thing. What is the real risk level in the country?
Domestic investments are always the majority of fixed. Domestic investments are always the majority of fixed investments in any country. So that's for sure. That's the most important thing we should focus on.
So in an actual stress scenario, the capital base based on local investors proves stickier than the one based on foreign investors. Is that okay to say?
I think there's a sort of a fetish about foreign investment here, because in the early 90s, there just wasn't any money locally. So having a foreigner turn up, whether it was to take over a hotel and renovate it or build a greenfield factory, this was enormously important. It was like embassies opening. It was a sign that the outside world acknowledged the restoration of independence. And I think there's still this lingering feeling that there's something sort of almost sacred about a greenfield investment. But I completely agree. The most important thing is, that I would be worried, the only thing that would really worry me would be if the existing investors were pulling out of a country. That's a sign that something's really wrong. But let's leave Britain out of it.
Just to follow up on what Edward said, this is also the way we have been looking at it, at least at the central bank in Estonia, that there used to be this very strong focus on foreign investments, especially in the 90s, maybe early 2000s. Now I think we care more about investments in aggregate. It doesn't matter if it's coming from foreigners or for Estonian investors. We have built up some capital in Estonia. We want to have the business environment that supports investment. We also don't want the Estonian entrepreneurs to invest all their money abroad, but so it doesn't matter where the investment is coming from. We just want to have enough of it, and I think the experience so far shows that we've been doing okay. I guess, as a side note, you may also look at from a perspective of a local investor that this is your country, this is where your family, your assets mostly are. And you have faith in the future of the country, and if really the worst case materializes, then I think you have bigger problems than just worrying about the return of your one or the other investment. So I guess that's why also locals normally are more stickier as investors.
That brings us to the issue of faith versus fundamentals, and Governor Šimkus in his opening remarks already quoted Keynes' description of investment as an act of faith in the future. what actually sustains that faith at Europe's frontier today? Is it institutional credibility, NATO security, EU integration, demonstrated crisis performance, or something else altogether? Can I start with you, Mr. Lucas?
Yes, I think Keynes was a brilliant investor. Let's not forget that. He wasn't just a great economist. But I think for me, the most important thing is that there was a lot of skepticism in the early 90s about so-called Eastern Europe. And it was seen as this sort of, weird, backwards, probably racist place, and you have to take dollars when you go there in cash. It's the one thing people knew is, should we take dollars? And it was a big bet in those days to go along with EBRD and the other frontier, as they were then, frontier investment funds, and say, no, this is going to be a big success story. And the people who made that bet have done really, really well. And the people who said, no, let's keep on investing in traditional West European financial markets have done all right, but it's been an absolutely enormous success story, and I would say particularly relative to the starting point in the Baltic states, also very important, very big in Poland, and it's really hard to make the argument that that's it. And you can say they're now stuck, middle-income trap, convergence has slowed, and we've had the best bit. But I think there's an even stronger argument which says the best is yet to come. And so that, if you think that they've now caught up from a very low starting point, pretty much close to the European average, and there's still this huge hunger among the entrepreneurs and the decision makers, not just to catch up the West, but to beat the Old West. People who've been to university in countries in Western Europe, and they think, well, these people don't work very hard, they're pretty stuck in their ways, they're pretty complacent. I don't want just to match them, I want to beat them. And I think I sense that hunger is still really here, and so I think that is the fundamental case for investing in the B3 and in the region more widely. And Finland as well.
Lovely, thank you. Very briefly before sort of, if we think on the whole Baltic region, or from Poland to Finland, I think for me the important issue is that the determinants and sources of economic growth are the same everywhere. There is no special Baltic countries related this and that. Sort of things have changed certainly from the early 1990s. We're all confronting very similar challenges of economic growth. We share, Finland, Latvia, Lithuania, Estonia, we share the same currency. Finland is a newcomer to NATO, but sort of even that is now sort of the challenges are the same. And also, then the solutions are local, but there's nothing special about the region in this sense anymore.
Yes, when David asked what sustains the faith, is it institutional credibility, NATO, EU integration, demonstrated crisis performance? I think it's really all of that. But now, I guess the situation where we find ourselves in economic terms has changed in the sense that there was this convergence story in the Baltic countries, the costs being lower than the EU average. We're slowly catching up in terms of our cost base, but also incomes. So I think that, in a way, has run its course in the sense that when you look at costs, then they are pretty much the same in the Baltics as they are sort of at the EU. In the EU, as an average, you might argue, at least we feel in Estonia, that we're so integrated with Finland, for example, and Finland has a higher price and cost level still, that maybe we are sort of naturally converging even more to Finland and moving above the EU averages in terms of our costs and prices. The incomes are not there yet, so that's of course the problem. But when you think of our other strengths, then I think it's still the business environment, the quality of the institutions, but also the quality of the services and the products that we can can offer, I think, also in general the flexibility and the, sort of the nimbleness of a small country and also smaller firms. And at the end, I agree with Laura that the challenges that we face, they're really the same that are there for other European countries at the moment. So we have the need to invest in defense, to finance it. We are very much interested in lowering all sorts of internal barriers that we have in the EU still for trade in goods, but in particular in services, because that's where we would benefit if it would all be more sort of fluid and smooth. We would benefit from better integrated capital markets in Europe, so we're very much in favor of that. So indeed, we have just the same challenges as I think every other European country.
So I just don't agree. I think there is something special here, and you talk about capital markets. At the moment, the Baltic capital market, in terms of traded equities and bonds, is really stunted. It's counts along with, it's not even an emerging market, it's a frontier market, which means it ranks along with Burkina Faso and Senegal, which is astonishing given the level of income and institutional development. So just to give one example of catch-up, if you could get 6 big listings onto the Baltic NASDAQ, that would get the Baltic out of frontier market into emerging market, and you would instantly get between 300 million and 400 million euros in portfolio investment. So that's a big one-off gain that is just sitting there. Now, it requires B3 government cooperation, and it's a collective action problem, because at the moment it's chicken and egg. There's no liquidity, so there's no listings, and there's no listings, so there's no liquidity. But you could do it. So I think there's still opportunities to make big jumps forward.
Just before Mr. Edward jumped in, I was thinking to say that it's hard to disagree in this company. But listening what you've said about the capital markets or savings and investment union more broadly, my answer or my reply would be yes and no. Because David, you mentioned 3 reinforcing pillars: NATO, European Union membership, and I forgot the third. But Eurozone, exactly. But when you think about this in particular from the European Union perspective, so what's the point or what's the goal? Is there were to have 27 different capital markets, and to admit that what would be the difference between the capital market in Tallinn and capital market in Vilnius, or to have one which is very efficient, very functional, very smooth, and very much approachable for every kind of business, every size of business. And that's the beauty and benefit of this European Union integration. So instead of building, maybe it's a bit optimistic now that we could build very quickly a European Union or European capital market. Maybe we could start with some regional capital markets and then to, so to say, to move further onto the European one. But I still see that benefits of the integration are bigger than just, to build our own capital market and to have these very high listed companies. So having said this, I was also thinking what you, Laura, said. So we have many things or when we say Baltic region, of course we do mean not only Baltic countries, B3 as you said, but also Poland and Finland. So countries neighboring Russia and being at the Baltic Sea. But it's definitely what's in common. This is the NATO, European Union, and Euro. Maybe Poland is not in Euro, not maybe, but it's not. Maybe they will join someday. But it's also an important thing how, and you said that the growth factors for growth are the same, yes, but they are not the same for every single country in the world. And in the beginning, Edward mentioned Moldova. So we basically started from the same start line, but somehow we ended with the different results. And I think that something what the European Union, Euro membership, NATO bring is the rules, very clear rules, law going first, clarity, strength and quality of institutions. This is something what not only brings prosperity, but also a very important preconditions for faith and confidence of investors, because this is something that would save the investors in the country, like this region. So, yeah.
Okay, one point that the presentation we saw previously made was that defense spending is on the increase, understandably. And as defense spending structurally rises, how can policymakers prevent a crowding out of productive investment while at the same time preserving fiscal credibility and financial stability? Would one of our governors care to address this?
Okay, I found this on the web for productive investment.
Someone is using ChatGPT. I'm not. So let me let me tell you what I think. So I think the starting point, speaking of defense investments and whether it does crowd out or not anything else, I think the starting point is that it's just the necessity right now for European countries and the Baltic countries in particular to build up our defense capabilities. And I guess those questions about side effects, they're sort of secondary at the moment, but still, they are of course important. Having said that, I think actually, as it was also said in the opening presentation, really, I think the primary effect is that investing in defense and giving the confidence also to investors that the country and their investments are protected, it doesn't crowd out, but it in fact reinforces the confidence of investors, and in that sense is also helpful for the rest of the economy. But then let me just make a couple of additional points still. I think you can also look at the defense industry that we have now sort of coming up in all our countries. It's really, well, it can also be a productive industry when you end up innovating, exporting your products. You would sell to other governments. It's not really an open market in that sense, but still you can earn export revenues, and it can also be a productive business. What we're also seeing right now is that even if we have those new defense companies investing also in new manufacturing capabilities and R&D, much of the spending that we're doing now on defense, it's really imports of equipment from abroad, since we just don't have this all the capabilities that we need yet. So it's maybe, even if we call it investments in defense, it's not really all investments. Much of it is just purchases of foreign military equipment. And finally, what we do need also when looking at those new technologically advanced defense companies is that we need more foreign experts that we see are also coming in and working for those Estonian new firms, and that, I think that's a favorable development. So normally when you get those highly skilled foreigners coming in, they can give you another boost to the economy and also support the rest of the development. So certainly there are many positives also that come along with developments also in defense sector.
Just to build up what Madis has said, so it's absolutely necessity now to increase spending, but not only in this region, but also everywhere in Europe, I think. But it's also, so when you look to the European defense spending and you compare this, let's say, to the US defense spending and some other, and defense spending by some other countries which spend quite a bit on defense, you'll see not only the difference in, so to say, in size of the money, but also in structure of the spending, on what the money is spent. the more money, so then the question now that we have, I guess in Baltic states, numbers are similar, so we are spending about 5% of our GDP onto defense. The point is not only to spend more, but to spend wise. And then you compare average EU spending on defense, and it's structured, let's say, to the US defense spending, you'll see the differences in what percentage is spent, let's say, on salaries, on infrastructure, on innovation, in research and development. So it starts with salaries, of course, right? Then it goes to infrastructure, but then the rest goes or may go to the innovation, research and development, and other things. And I very much want, and I do believe that this will happen also in the EU. So let's think about some technologies. I see my member of the board is writing a text message, but he's using mobile phone, not so, and GSM. So these are the technologies that were invented for the defense purposes first of all, and then they found their life in the civil, when they start living in the civil life. So what I mean by this, that when they talk a lot about struggle of productive investments in the EU, need to increase the productivity, etc., etc. So it's also about money which is spent on the defense, but it finds its way through the innovations, research and development, experimenting activities, finally into the productive areas of civil life. So this is one thing. And the other thing that your question was that does the defense spending somehow crowds out private investment? My answer is simple, no. I think it crowds in security and resilience. And these are the preconditions for private investment. So, yeah.
Thank you. This is an excellent question, as you realize, and I fully agree with both governors. When sort of thinking on the potential effects of increased defense spending, of course, there are two dimensions that are of critical importance. One is how the increased spending will be funded, and that's the fiscal policy decision, or whether that means more government debt or increased taxation or decrease something else. That does have sort of repercussions on monetary policy as well. But then the other really essential dimension is, as you just mentioned, is the structure of spending. First of all, what share of increased spending will be on procurement of material, and then there the critical share is what share of those new equipment and material will be either domestic or produced in other EU country, and what will be exported from elsewhere. And that's the critical policy choice that our policymakers are able to do, and they will have to do. And then the also sort of what share of the total expenses will be dedicated to research and development. And that is actually one particular field where certainly more European cooperation would be especially welcome. So on top of the Savings and Investments Union, we would really benefit from having a defense union that would sort of build upon each other's capabilities in research-linked R&D sectors. But that's then, so these are the dimensions where the activity will be going forward. Thank you.
Thanks. I think in a technical economic sense, I don't worry about crowding out, but I do worry that we have a huge problem with defense finance in Europe. We don't spend nearly enough. as Europe, and what we do spend, we spend very inefficiently. And I think there's a really strong argument for having a sort of EBRD for defence that would borrow money on the capital markets based on its government shareholdings and then act as a sort of carrots and sticks to ensure that the defence money is better spent. But that's not a Baltic problem, that's a sort of EU or wider Europe problem. I think for the B3, getting back to this idea that there's a geopolitical bullet point when you come to your investment decisions and people want to tick that box, and being able to say that President Trump has stressed that the American security guarantee to Europe is strongest for those countries that spend what was originally 2%, is now gone up a bit. And just being able to say the Baltics spend more than the United States is asking for. They're five-star members of NATO. That's a very quick way of getting that geopolitical box ticked and moving on. In addition to which, there's also the very important point that defence innovation is booming in Europe, and by having all this money around, you help depict the B3 as the sort of defence innovation laboratory of Europe. You've got the Ukrainian battlefield experience and frontline innovation coupled with manufacturing to EU standards, which is extremely attractive from investors' point of view. There is a bit of a problem about defence loan finance for defence tech, and I know that Frankenberg and other companies find it difficult to get the banks to lend the money for the production expansion, or they have found it difficult. So but that's a sort of a limited technical problem.
It may sound counterintuitive at first, but is it possible that proximity to geopolitical risk paradoxically serves as a competitive advantage in the sense that it accelerates innovation in institutional quality and strategic investment? Or is this just an unsustainable narrative? Anyone have a view?
I think you've just answered your own question, and Katrina put it very well. No, I think that this idea of the harsh environment providing very strong, in biology, a harsh environment produces evolutionary responses. And I think that the difficult historical environment for the Baltic states has produced very strong abilities in multitasking. For example, people hop from role to role to role in a way that in the rest of Europe is really quite unusual. You pick your career in your 20s and you stick to it. And here, looking around this panel, we see people who've done lots of different things. Looking at you, Madis, in your career. So I think that sort of flexibility and dynamism is a product of having to start from absolute scratch. When I lived here in 1991 and 1990, just making an international phone call was a major, it was one of your big jobs for the day, was I've got to call Germany at some point today, how am I going to manage it? In the parliament, there was a guy called the faxistus, and remember that? His job was just operating the fax machine on one of the very few direct dial phone lines that this country had, and he would dial and dial and dial, just trying to get faxes through to the outside world. When you've dealt with that level of difficulty at the beginning, the sort of problems we're dealing with now seem quite manageable.
Thank you. So recent events underscore what a volatile world we live in. Of course, the Baltics have built up a lot of credibility through repeated crisis adjustment. But is this crisis reputation premium durable, or could a geopolitical escalation abruptly erase it? Anyone?
And I just add one thing. It's quite hard. We were just complaining about the capital markets. But one quite good thing is it's very hard to speculate against the Baltic states. I remember in 2007, 2008, these sort of hedge funds were thinking, these countries are looking in a bit of trouble with the euro peg. How can we short them? And it was really hard to short the Baltic states. There was very little tradable debt. There were very few. The derivatives market was almost invisible. There were credit default swaps on Estonia, even though Estonia actually had no foreign debt to default on. But you were at the sort of far reaches of what the financial markets could do in terms of placing these bets, and that provides a kind of firewall if people do want to speculate on the basis that there's going to be some catastrophic result in Ukraine, and therefore people are going to say the Baltics are next, and how can I make a financial bet on that? I think that would be quite difficult.
Yes, I think perhaps it helps that it's not that easy to directly speculate against the Baltics, and also the fact that the ones who tried back then, they lost money. So it is true that we have probably this reputation of coming successfully through a number of crises in the past. You call it a sort of a premium or sort of extra trust that perhaps investors might have also in our region and in our countries. It might be true, but of course I also think that it is easy to lose such trust or this premium if you are not able to maintain reasonable economic policies. Somehow you slip on a number of things. So I think still, for small countries as ours, it is absolutely important to continuously work on maintaining that credibility and have the necessary buffers at the government level, and also for corporates, they have to be resilient. And at the end, I think there are very few countries in Europe who that can afford not to think like that. So in that sense, indeed, the sort of unity of us in Europe, that really should be the ultimate source of strength. So if we're talking about resilience of our economies, we should probably not focus on resilience of individual member states, but more about the resilience of Europe and the current situation bringing us more together.
And today we quoted already a couple of times Keynes and his quote on investment. But I think this was also Keynes who said that don't let crisis go in waste. I don't know how well this fits to other countries, but this fits very well to Lithuania. And also we mentioned these institutional factors such as EU, NATO membership, Eurozone membership. And when you look back into the history, 1999 Russian crisis, 2008 global financial crisis, 2014 occupation of Crimea, 2020 COVID pandemics, 2022 Russian invasion into Ukraine. Somehow this country managed to use these. I mean, some of these events are tragic. They are very bad, but somehow businesses here in Lithuania, they managed to use the situation and, so to say, to use the situation. And even if sometimes the economy has fallen, then it quite quickly recovered and grew even faster. So if you, in a way, try to draw a line or to make a relation, to draw a line, a trend over the years, so you see that Lithuanian GDP is growing or is staying on this line on average throughout the 3 decades. And this line is quite steep, you know, expressing the speed of growth. Also on the small and open economies and our, like, this specificity of ours. After, I don't know, after decades of saying we are a small and open economy, somehow I started disliking this term small. We are not small economy anymore. I think we are a very compact economy. And with this word, we also can express our strengths. We are very agile. We are very transformative. We are very quick in adjusting into a new situation. We have a lot of energy. We have new technologies implemented and introduced. We have this very close relationship between businesses and governments. Always it can be better for sure, but it's way better than in many other countries. So we are compact and open economy, and the agile economy, and we make use of it.
Thank you. So we still have a little bit of time left, and it gives me great pleasure to open the floor for a short round of questions from the audience. And we'll start with a question from the audience here in the room, and then turn to the participants who are joining us online. Please, if you have a question, state your name and your affiliation, and if your question is directed to a particular panel participant, then you might want to indicate that. For those asking questions in the room, a microphone will be brought to you. And please use it so that the participants joining online can hear everything clearly. Any questions? Oh,
Katrina's got a question.
Thank you. I have the obligation to translate the questions from our online audience. And we have one question online, which is, I suppose, directed to the governors of the central banks. And it sounds, how will the war in Iran and its implicated oil price shock affect the ECB monetary policy decisions?
it's not me. I didn't ask.
Those who don't know, David is a monetary policy journalist.
But I'm here, so I couldn't have asked it.
So he couldn't ask his question. So this was somebody else. But I think like this. So when we say that we take decision meeting by meeting on the basis of the best data available at the meeting, that's exactly what we mean for this particular situation. And that is why it's so important. Maybe it may sound a little bit boring, this repetition of the same combination of words, but that's exactly why it's important. Because even from the beginning of this year, we have already had so many events that would be enough, I don't know, like for 5 years. And when I look 5 years back, we have so many events that would fit, that would be enough, I don't know, like for 5 decades. And so having said this, I think what's important then when I think about our next meeting is to stay calm. Because we talked about the headline volatility and things are changing so quickly. Over yesterday, oil prices went up from 80 to 115 and then back to 90, something like this. I don't know, I don't have now the right numbers. So throughout the day, it changed like by $20. So if you start thinking about monetary policy in the morning, you may end up with a very different thinking in the evening. So stay calm, take things or think about things with cold brains. We have this expression in Lithuania, and don't overreact, because this is a week when things are developing in Iran. Of course, I'm aware of the change of the market perceptions, and of course, if things would last, if things would spread, if the things go deeper, it will have implications not only onto inflation, but also onto the general economic situation, not only in the Middle East region, but also wider for the Europe. But as for the coming meeting, I would say we of course we will discuss and will try assess all the possible implications of the events in Iran onto European economy. But I would say for the moment we should stay our course.
I'm also impressed, David. How did you manage to put in this question while moderating the panel? But I know there are other close observers of ECB's policies. So I could sign everything that Gediminas just said. Maybe just to add a little bit, we do remember that the surge in inflation that we experienced since the second half of 2021, it was driven by the sharp increase in energy prices. So now there's this volatility that we're seeing, a lot happening, a lot of uncertainty about the developments, for how long the energy prices will stay as high as they are now. So I agree with Gediminas that we shouldn't rush into any decisions. We should first see if this increase in energy prices that we now are experiencing, if that turns out to be transitory or not, as it was the second case in the last time. But I guess it's perhaps fair to say at this point that even if we shouldn't rush into decisions, the probability of the next change in the policy rates now being more towards an increase rather than the opposite, that probably has gone up in the last couple of weeks. But I don't think we should rush into any decisions.
Are there any further questions? I think we have one there.
Hello, Egle Koppa. Thanks a lot for an interesting discussion. I was actually wanted to follow up on something you've discussed already. So we talk a lot about the fact that we feel resilient here in Lithuania, in the Baltics, that we feel strong. But actually, do you have any advice or ideas on how to translate our resilience to Spanish, to French, to Italian? How do we export the idea of our resilience? And actually, do you think it's really needed? Thanks.
Well, thanks. You're absolutely right. I mean, people in Western Europe think, if they think at all about this, that there's some kind of problem in the Baltics. What they should think is there's some kind of solution. When I say Baltics, I'd start with Finland with its comprehensive defense model. But on your vigilance, your readiness, and your resilience, you have a lot to teach the rest of Europe if it wants to listen. I think one thing would be to have more B3 cooperation in this. And I've been singing this song since about 1990, but I think 1 + 1 + 1 = 4, actually. And to some extent, we see when the Baltics are trying to get their message across that there's not just competition, but sometimes confliction. And I've been to conferences where there's been a Estonian-sponsored fringe meeting at lunchtime happening on the top floor and a Lithuanian one happening in the basement, and the same people who are interested ended up divided between the two. So I think there's a bit more, I mean, I'm working on this at the moment, but I think trying to tell the Baltic story and this message, be more Baltic, with a bit more coordination might mean it would have more impact.
If I may add just a thought on, because resilience is maybe a different thing than risk perception. The risk perceptions, especially when it comes to geopolitical risks, do differ country by country. And then sort of, for how I see resilience is actually, it's resilient businesses and resilient systems is something that are not afraid of shocks. It's not about things would always stay the same if things are resilient, but it's rather the state of mind that, well, shocks and crises will come and go. We know we will survive those. And that's sort of that's what resilience in in actually, I think much of what we have right now discussed is described about. And honestly, I do feel that Spanish certainly are resilient in their own way, but they still might have a very different view on the geopolitical risk here in the eastern flank.
Perhaps just to add a thought in addition to this point on resilience, I think we were also talking about the dynamism and sort of looking for policies that support growth. And this is something I think I'm not sure if we have a very specific lesson from the Baltics that we can give to other countries, but I feel that it's equally urgent for sure also in many other bigger European countries, maybe even more so, because looking at the challenges that we have for public finances, we have our problems. I think the Estonian public finances are not necessarily on a sustainable path now, but then I think it's even much worse in many other European countries. So I think this is something that I think people need to at the end realize. Very often policies change as a result of some sort of a crisis. I think we should just hope that this is not the case, and the governments can introduce this necessary dynamism and sort of pro-growth policies without getting into a huge mess and with the finances before that happens.
Okay, that brings us to the end of the first panel. Thank you very much to all our panelists. Before we move to the next discussion, we're going to take a very short technical break. For those joining us online, the event is continuing. We'll resume in just a moment. And for those of you who are here in the room, we'd encourage you to remain seated, if possible, while we make the changeover. But in any event, please don't go very far, because we're going to start again in about 5 minutes. Thank you. Back. So we discussed in the first panel how stability and confidence are framed at the macro level, and now we turn to how they are tested in practice, in investment decisions, capital allocation, and business expansion. Let's begin by introducing our panelists. Once again, we're joined by an excellent panel for our discussion. So, starting at my far right, we have Professor Vladas Algirdas Pumelis, founder and director general of Northway Biotech and a pioneer of Lithuania's biotechnology sector. Next, Rolandas Valiūnas, chair of the Investors Forum and managing partner at Alex Valiūnas, long involved in strengthening Lithuania's legal and investment environment. Next, we have Vida Staskonienė, director of the Investment Development Department at Invest Lithuania, which works to attract foreign investment and support international companies establishing operations in Lithuania. And to my immediate right, finally, we have Kinga Stanisławska, co-founder and president of European Women in VC and managing partner of Experior VC with more than 25 years of experience in venture capital and private equity. Let's start by talking about confidence as capital infrastructure. We often treat capital as mobile and confidence as intangible, but if confidence is the true infrastructure of investment, what are the concrete institutional, legal, and narrative mechanisms that make capital stay rather than simply arrive? Kinga, may I start with you, please?
Thank you so much for that question. If I could summarize it up on 2 words, I think it would be predictability and stability. And those are key for investors to be able to judge an environment and to commit to that environment. So what I'm talking about really is cap tables that are set and that are well known, legal structures that are clear, a tax regime that doesn't change, a bankruptcy law that does not make people who had to close companies somehow penalized for a decade. It's all these things that truly bring capital as an infrastructure to a country. And looking at the past years of Lithuania's success, it has been truly measurable. We have more unicorns in Lithuania than in neighboring Poland, even though, and I think in terms of per capita in Europe, it's top 5 right now. So what I'm talking about is Nord Security, Vinted, Baltic Classifieds, as well as Cast AI now. And these kind of companies are truly showing that capital is coming and the talent is here. So the startup ecosystem in Lithuania has grown something like 40 times over the last decade. And valuations have gone up something like 7 times over the last 5 years. And truly, if you read the Deal Room report, you will see that Vilnius is one of the fastest growing tech hubs in Europe. So this is really commendable. What's important is many of the things that were said on the panel preceding this one. The regulation has been stable, the business policies have been friendly, it's been easy to set up companies and run them, and funds, actually. And the bureaucracy is low. So all these aspects help to build stability and the capital infrastructure.
I can follow on that as well. So when we talk about confidence, usually we think about it as something intangible, but actually for investors, it is very concrete and it is experienced through the daily operations and the experience with working with institutions, regulation, and overall business environment here in Lithuania. So in Lithuania, we are trying to make confidence tangible very much, and actually it's not only talking about it, not only communicating, but also executing. So for example, Invest Lithuania is a one-stop shop for investors and helping them to navigate through this complexity. And more than 20 years we were working only with foreign direct investors, But since last year, we also are working with local companies as well and helping them to establish here, to expand here, and talking about execution, not only talks, but execution. So there is investment highway initiative, which is applicable both to local and to foreign investors, where we accelerate large strategic investment projects in Lithuania by helping them to not, I would say, overcome bureaucracy, but to ease bureaucracy, to ease procedures. And for example, for certain strategic industries as defense, companies can start building manufacturing facilities even if they do not still receive the permits, construction permits or environmental assessment permits. So that shows that Lithuania is ready to help companies to foster all procedures in order to attract them.
Thank you. For me, confidence of investors are based on the 4 pillars. Well, I'm a lawyer, so I need to structure everything up. And the first is politicians, second is the public sector, the third is judicial system, and the fourth is reputation. So, of course, predictability of politicians of what they do, because we'll have elections. If not tomorrow, then in 2 years, in 4 years, and etc., etc. So investors, they realize it will be the changes. But they would like that changes would be predictable. They would be not too much radical, unless those changes are on the positive side. Not always happens. And then they can trust in the system. The second, public service. From the investor's point position, I thought, what is the most important impact in the investor's confidence? And my approach develops during the years, opinion changes. And the last 12 years is definitely public service. What public service does, how quickly it guarantees, reacts to the needs of investors or makes the obstacles, that's probably for me is the number one thing that would make sure the local investors would invest here rather than bringing capital to the somewhere west of Europe or Poland at least. And foreign investors also would consider the place as the one of the best. The third, judicial system, I mean the people need to trust because they know it will be some disputes, maybe not in 1 year, maybe in 10 years, maybe in 20 years, but it will be, something will be happening. If not with the contractors and with employee, whatever. So they need to trust that the judicial system is fair, that is not the one-way highway, and the justice is there. And the fourth, as I mentioned, reputation-wise. I remember very well, 20 years ago, I talked to the CEO of Philip Morris, here, the Baltic one. And he said to me, Rolandas, Lithuania will never be a developed country unless you have at least one brand. Like McDonald's, Legos, or whatever. And for 20 years, I thought, well, when we would have this brand? Where we would get it? Is it Girteka or Maxima? No, that would not work as the brand for Europe, at least. And suddenly, in the beginning of last year, I realized we have at least 3 brands. At least 3 brands. Vinted, if you talk to anybody in Europe, well, many of them would think that it's French, half of them would think it's Polish, but they would know what Vinted means. And if somebody wouldn't deal with Vinted themselves, they okay, my spouse showed me, that this is a good platform and we can, for many years I thought you can buy the clothes there. Now you can buy the book. And that, well, to be fair, I never used Vinted myself, but whatever. The second, if you would talk to anybody in Europe from business, maybe not to the truck driver, but if you would ask, do you know what is NordVPN? Everyone would answer, yes, of course. Is that French or English? No, it's Lithuanian. I mean, it's here, it's developing, it's growing each year. And the third, well, you might argue about the origin of the capital, but all started here. And Revolut probably is the most known of these brands, and still the big team is working here. So reputation-wise, this country moves so far in the future, and I see other brands are coming, and really that helps us to move forward.
Okay, so today we are talking more about confidence, not about trust. And it's clear that capital it's movable and it is global, and confidence is local. And question it is how to establish confidence that to keep capital in your country. So it is my understanding key discussion which we would like today to discuss and to understand more precisely. And because I was mentioned here like a local investor. So my understanding it's no difference. You are local or you are global. And in my understanding, if you are investing money, investing your capital, you are investing not just by emotion, but you are investing by very simple rule that business is to make a profit. And if we could not make a profit in country, and environment, it's not acceptable to make a profit, so nobody will come here and nobody will invest in your country. So how to establish it and to find, let's say, more in area where I am, in high-tech area. So my understanding, very important it is in business legal, and to have a stable legal system, what's not changing every day, to have a good legal professional people in country who could support investors to understand the legal situation, and to have a good lawyer companies. One of lawyer company are sitting close to me, and it is one of very, very well recognized lawyers and lawyer company. So it's one. And very important it is science and education for confidence in country. And if someone clearly understands that here it's no science, no scientific, no good people, no talents, also no one will come here, and we could not show good confidence in investment environment, and it's connected, of course, with talented people. How many we have here? Which level of this talented people it is? So why in Lithuania we are mentioning, two big problems. It is demography, and second, it is education. It is two priorities, in short term, what's now Lithuanians are looking how to resolve. And yesterday, I tell us that we should educate from Finland in education, because they are much better compared with us. But, Lithuanians, we are also, smart people, and we believe that we will establish our own system, which will be much better compared with Finland. But anyway, we will see. And the last one, what I would like to mention, it is governmental support. And let's say in areas and where I am, my understanding, we are not bad, because in Lithuania we have some priorities in some areas which we would like that investments will come. Mainly it is high-tech, and one of such a priority it is a biotech, and we have a very nice program, what politicians signed, that till 2030 we should produce from, modern biotech 5% of GDP. it is easy. No, it's not easy. You know, if you will not invest, if you will not attract foreign investors or Lithuanian investors, you know. So without big investments, it's impossible to do it. So it is some few points what I like to mention. And in biotech, it's good because investors, you know, when they are coming, they should build facilities, they should build factories. And you could not go like, you know, out from country tomorrow, like, I don't know, with the services centers for banks or something like that, you know, because it is already a facility and you should continue to run. So few remarks from me.
Thank you. So following on this with a closely related question, what makes investor confidence persistent rather than cyclical, and how quickly can geopolitical shocks, regulatory uncertainty, or political narratives erode that confidence? Anyone? Please.
So as Invest Lithuania, our main goal is to attract investments. And when we talk to investors, we pitch Lithuania. We tell the story about how good the location it is, what talents we do have, what is our educational system, and what is the regulation. And to be honest, sometimes we tend to overpitch, you know, in order just to attract them, to get this visit, to show them around, to connect with local partners, and to show how Lithuania is good. But when the investor invests, right, when it chooses location, it is definitely very important to prove and to build that trust. So if we said one thing, we have to deliver. So if there is a support, investment support, so it should be provided. If there is laws, they shouldn't be changed overnight. So the decision-making should be predictable, and this trust is built over and over again. So all those reinvestments, they show that investors believe in our country. They tend to reinvest here, and the previous panelists also told about this, that, you know, these reinvestments sometimes is even more important than new investments, especially in this geopolitical situation where it is very difficult to attract newcomers. Because, you know, all this narrative, our communication as well is very important as we're talking about these risks and everything. So when the war happened in Ukraine, our response was immediate, actually. We called to our investors, we talked to headquarters, invited them to come over, organized meetings with the Foreign Minister of Affairs, with Minister of Economy and Innovations, and we were telling what is our response, what government is doing. And I think those things, they kind of build trust and confidence in us.
I have tickets for April 8th. And I have hotel booked for 9 days for my family holiday in Dubai. I need to reject them by Wednesday. It's Tuesday, still not, but not because I believe I can go there, because I'm lazy, you know, and, you know, I need to come to the moment. I'll do it this afternoon anyhow. And some of people I know, they were planning to relocate their top management to Dubai, keeping the same salaries, because that would mean essentially a 40% raise for them sitting there, and the company would have the same cost. And suddenly things change. And now that's the good example how geopolitics and how external impact would change the confidence in the country. And I have no clue and not understanding how quickly Dubai would be able to rebuild it. Probably nobody knows, because we don't know how long those war and actions, military actions would continue there. But also there are internal things which were already mentioned before. And it takes a lot of time to build the confidence. And I believe for Lithuania it took since 1990 to, let's say, 5 years ago, where I feel we got the confidence, where where we started to speak to partners, investors as equal to equal, where we do not feel we know less. Sometimes we believe we know more, and we are more energetic. And the hungerness was mentioned in the first panel. The hungerness is the driver for this country, I believe, which is most important, really. And if regulatory matters, if politicians, if public servants would go to the wrong direction, that would kill the trust very quickly. And that would be a very sad matter for this country that built this confidence for so many years. But there is one more important thing that we can do better. Each country could do it better, including us. That's trust between the business on the one side and the politician, public service on the other side. Because business, which doesn't want to have the surprises, it wants to talk. It wants to understand what the political agenda is on the table, what politicians expect to do. And not always politicians on the same page. They're afraid of business. They might be afraid that maybe journalists or maybe other politicians would blame them talking to business, working for business, etc., etc. So I would say one of the goals for this society to continue with the confidence is the building dialogue between business and public service. And probably this event of today is one of the good examples where the things are happening. And Professor Bumilis and I are happy to be on this panel as some private representatives.
Yeah, my understanding it is that investors like stability. So it's one. And investors like the direction of country. It's not changing every day. We have a political periods. One day it is social democrats, and as the conservatives, they have a different thinking, different understanding about business. But in my understanding, most important, it is the direction of country should be stable. And everyone understands that if, let's say, it was biotech, lasers, IT, and someone, it is priorities in country. It is priorities not for 3 years. It is for decades. And such priorities to keep, it is one of, in my understanding, key issue to keep, environment of investment here in stable situation in Lithuania. So it is one. Second, of course, it's helped us that we are EU members and we are NATO. It's a different situation now about NATO, but still, it is two serious organizations. What everyone understands that if we are in such organizations, so it's helped us to keep our political direction in the same way. So it is my understanding also one of good issue here, and also it is very important that if, let's say, right now, what we are telling, what we call, direct foreign investors, they may be a little, few years, they are not coming so intensive. But if such investors like we are, local investors, we build facilities, we show that we are investing money. So in this case, foreign investors also understood that maybe it makes sense. And maybe, here it is this good confidence in environment for business. And they start to join and to do it, not so, be afraid about political situation, not geopolitical situation and so on. So a few my observations about it.
Maybe to look at it from a very narrow angle, we are technology investors, and Revolut was mentioned. That's a digital bank. So it would seem that if the Baltic states are going in this digitalization direction, which they're doing very, very well, with Estonia leading with its e-residency program, setting up new companies, and of course, Edward, I think, being the first Estonian e-resident that we have in the room. With that direction, that's a huge, huge part of what investors are doing these days with digitalization, software, with AI. And we can build much around that if we set up the systems right, which are digitalized, which are safe, which are secure, and which are aligned, and which are online. And I think that the Baltics can do very much here, joining up together, because you can really leapfrog ahead of everybody else. There was a saying I heard once in Brussels, this is to do with Estonia, that basically Estonia should just export government as a service. And perhaps this is the thing that really could be not just cyclical, but very much leapfrogging and permanent, if the rest of Europe could learn from your digitalization examples, your strength in software, and your future building of AI, where your strategy is also very clear.
Thank you. Let's get into some practical specifics. If a government offered investors tax incentives or subsidies, would that potentially compensate for weak institutional confidence, or would it just mask underlying credibility gaps that would eventually surface?
You know, when you are an investor, each euro, it is very important. And if government gives some incentives or some subsidies for investment, of course it's good. And if you are looking in Lithuania, it was a little differentiation between that. If you are foreign investor, what's called foreign, I don't understand what's foreign, or you are Lithuanian investor. So if you are Lithuanian investor, you could not get any subsidies, any support. And like I am joking, I am from small city Kretinga. So really, what's the difference between Kretinga and Berlin? It's no difference. We are investors. So and it's good. And now in Lithuania we are trying to change the rules that, investor doesn't matter from which country he is or which area he is, could get the same. But all this subsidies and everything will not help to attract investors. Because if investors understand that if he are investing 500 million, and for him, it will be given subsidies for 50 million. It is, I am not telling that bad money, but it's very small money which will not support to make a decision about investment if investor is not confident that all this investment will be for long term, will be, with the support of government for long future, that will be no talents here for who could work in this country. So it will never give. So once again, my answer it is all this subsidies. It's good, but it's not help to make and to establish a good confidence in the environment for investment.
Just to continue with that, I agree, it's not or. It's not either confidence or subsidies or other incentives. Subsidies could be helpful if other conditions are equal. But those other conditions, not just confidence, it's infrastructure, it's talent attraction, it's many other things. Because when investors decide where to go, they have this Excel sheet, you know, and they mark plus, minus, plus, minus. Sometimes they make the result mathematically, sometimes not. But subsidies is one of those plus or minuses. And if I would be Prime Minister, President, and Chairman of the Lithuanian Central Bank, I would be giving subsidies because I believe our infrastructure, our confidence equals or a little bit better to many European countries. But subsidy-wise, we are more reluctant, I would say, to incentivize the companies to come to Lithuania. And you know, when you give 10 million of subsidies and you get 100 million in taxes, you know, it's kind of win-win situation. So I believe, I hope our politicians would move to that direction even more than they are today.
So just, you know, I totally agree that subsidies help to attract investors. But if the investors are not confident in the location, they will never choose the country only because of subsidies. So when promoting the country, we always talk about the talent that we have here in Lithuania, about the competences that are already in place, about the companies, peer companies that are already operating and how they succeed here. Also, we talk about regulation and about the long-term strategy of the country in order to make investors to believe in us and to choose this location. Because, you know, as Mr. Bumelis have told, that decisions are made, you know, for 10, 15, 20 years. So the subsidies can last only for 2 years at the maximum. And when the companies are making decision to invest, to build a facility, it is a really serious decision that could take even 3 years to make. So actually our work is, you know, to keep this relationship with the companies and be, you know, very coherent in our message that the country can deliver. The government is very business-oriented, and as Mr. Bumelis already told, that we are looking not only to foreigners right now, we are working with local companies as well, because at the moment we are competing for local investments as well. So other countries are offering subsidies, and local companies that are willing, you know, to expand, they can go to Latvia, and we saw already a few investments in Latvia made by Lithuanian companies. And so it is really important for the country to compete, to stay in this competition, and the subsidies is only one of the tools that we have. But, you know, one very good example is how Lithuania became a fintech hub. It's not because of the subsidies, it is because of the regulation and the, you know, priority of the Bank of Lithuania and Ministry of Finance. And, you know, country being so agile and adaptable to future trends or future technologies is really important. So I think that, you know, long-term strategy is more important than short-term investment subsidies.
When it comes to confidence in an innovation ecosystem, what signals convince venture capital that a country is not only a place to start a company, but also a place to scale and exit? That would be for you, Ms. Stanisław.
Thank you. And there's a few things that investors see. One of them is serial and founders who reinvest back. And I think the Vinted example is a great one. Between Vinted and Nord Security, something like 30 new companies have been started. And the founders that have exited some of their shares from the companies are reinvesting back heavily into new startups, into new projects, into just doing new investments. So that's very, very important. It's one of these guiding pillars, because really when you look at other countries, it was the first unicorn that then made a wave of new technology companies happen. And this is happening here as well. So that's excellent. Another point is talent recycling. People leave companies, they set up new ones, but they stay at home. They don't leave, they want to build strength in Lithuania and are able to set up new startups, work for new technology companies. And what's also important is whether there are exits on the market and who to sell to. Are there enough large corporates to partner up with? Is it possible to do a local exit? And these things are the sort of issues that still need to be strengthened and built. From an investment standpoint, it's important to spot global trends and stay ahead of them. So one of those is AI. I believe Lithuania was one of the first countries in Europe with an AI strategy. There is now the 130 million euro project that is being built, which will bring AI talent and consolidate around it. Let's think about technology as really a spider web of hubs, and Vilnius with the other universities from all around Lithuania can use the AI, the Lit AI project in such a way. And then when I think from the point of view of an investor, I'd like to see more local financial institutions be involved in building out startups, in building out growth capital, and then providing liquidity. And this is a problem for the entire EU because the pension fund system is not investing in deep tech, it's not investing in breakthrough innovation, it's not investing in venture. Right now, something around 0.1% of pension money ends up in technology, in innovation, in things that truly matter to society. And we all have a challenge with that. I think that it would show a lot of confidence to investors from Europe and globally if more was done on the pension fund side and on the institutional side to align with startups, with breakthrough innovation, and with the IP-driven sectors that in the end really deliver the growth, the jobs, and the strength of the economy.
In West Lithuania, we do not work with startups. There is another agency, innovation agency, that has a Startup Lithuania unit and is responsible for developing those startups and attracting venture capital investments here. But to be honest, all these startups help us to promote Lithuania as a very innovative country. And huge corporations, rather than investing by themselves in greenfield, they are looking what they could buy, where they could do a joint venture investment or invest in already existing companies here in Lithuania. So this actually helps a narrative to be very positive from our side. But also at Invest Lithuania, we looked at the new investment trends, and we see that investments in bioeconomy, in clean tech, in defense industry are really important, and they also seek innovations. And here there are a lot of scale-ups globally that are looking for business development, of course, but also they are looking for capital investments. And from Invest Lithuania side, we're thinking to establish a new role at the agency to help those companies to navigate through these capital markets, banks, and public investments. And hopefully one of them will choose Lithuania and invest here.
King and Vida were very unfair and too much comprehensive, leaving very little to say. Just one observation. I don't know whether we can call testnet and Vinted startups anymore, probably not. But you can see two different paths that going around. Vinted is still attracting capital and growing. Testnet, owner of NordVPN and of many other brands, they don't need the capital. They spread the capital themselves, and they are investing in the new products and startups. And not only the startups, those people are investing in the new schools or educational system, becomes important for them. So it's very interesting to observe what those people so successful in their lives, they do with their lives and their business. And they were just startups 15 years ago.
I like startups, but in 2010 I was complaining that in Lithuania it's no startups. And when I am looking today, it is already so many startups. And startup ecosystem, we know together with you that from 100 startups, if one will be successful, it is already good. So really, my understanding is that we should support startups ecosystem and to show to our investors that here we have some good system. But we should not forget that one or two companies in Lithuania, if they start to make a little money, we will have an excellent Lithuanian economy. We should have a look more in industry and it is stable, make some products, what we could sell these products. And I am from biotech, and biotech every time we are telling that it is life science. I am telling it's not life science. Life science is good. Science we have a good. But we should establish life science industry. It is a different topic. And life science industry, it is big facilities, big factories, big investments. And such a job, it's not for startups. It is for foreign investors or local investors to do it. So we should combine, beginning with a maturated industry, what's already, let's say, biotech. We are already for more than 35 or 40 years. We are developing in Lithuania, and I am being a strange guy, building this bio-city, and in Lithuania we believe that it will be biggest hub in Europe, and with a quite significant investment. And I could tell that, I was surprised, but many foreign investors, they are interesting, and, we are in process to discuss that foreign investors, not only Lithuanian investors, will come to this project, and I am quite sure that we will be successful. So my understanding it is we should keep some balance between startups and industry, and to support both of them.
And speaking of biotech, that's an example of a sector with a relatively long development cycle. In such sectors, what forms of policy and financial stability are most critical for anchoring capital over decades rather than just years?
Here, Valiūnas tells that he knows about it. Could you repeat once again, please?
Sure. In sectors like biotech with relatively long development cycles, what forms of policy and financial stability are most important as a way of anchoring capital for decades, not just a few years?
Once again, if to return back to life science industry, it is one of branch of biotech. Most important here it is to find the possibility to attract investors, and to attract investors with huge investment. And if investors are making investment, let's say 500 million, it's not 50 million, it is 500. It will be necessary to return back. How to return back? To return back through making profit, not through making revenue. And investors are looking very, very carefully in situation. And once again, about all these parameters what we was talking. Do we have here in Lithuania talents? Do we have a real stable legal system? Do we have a continuous support from government? Do we have a long-term strategy in this area? And like I tell that, do we have a strategic discipline? You know, many times people have a strategy, but they don't keep strategic discipline. We should keep strategic discipline in areas which we, you know, indicate that it is our priority. So maybe, but what was your question?
Well, okay, I'll take it. I believe, biotechnology sector requires the same rules as many other sectors. However, there are a few distinctions. The first, judicial system was rightly mentioned, and IP rights in this sector probably the most important. And the way how IP rights are protected in one of the specific countries are of utmost importance. So I believe in Lithuania, our legal system and our court system is functioning really well enough. In comparison with 25 years ago, 30 years ago, we went through the miles on building the confidence. So we do have the people that understand what IP rights are and how they work, and I believe that that's good for us. The second item that would differentiate from the other sectors more, also not completely, it's what Professor already said, it's talents. Because you need very specific talents in the sector. And the question is whether your educational system can produce them or not. And sometimes your educational system doesn't produce them in sufficient number. So the question, how easily you can attract them from the other countries. So if you can do it, if you have the protection of IP right and you have the talents, everything else are important, but it's not different. Attraction of the money, you know, capital, whatever.
With life sciences industries, we are working since 2018, where the new unit was established at Invest Lithuania, and we were comprehending to that national life sciences strategy, you know, that you told before, and we're trying to attract another biocity or another Thermo Fisher into our country, but unsuccessfully. They were seeking for local ecosystems. They were trying to ask us, you know, what are you doing as a government? Are you producing talent? Are there some startups in this industry where that we could buy? Are there any other local companies that would like to co-invest? Because having in mind this our geopolitical situation, the risking is very important. So the trusted partners are also very important and play a significant role. So BioCity, Mr. Bumelis, your project we see as a really good marketing, and also not only a marketing material, but also a really good business case for foreigners to come and work together with local companies.
Maybe on the quick biotech topic, I had the pleasure to sit on the board of the European Innovation Council for 7 years and helped the EIC set up the EIC fund, which today is the biggest deep tech investor in Europe with 3.5 billion. And the biggest sector that the EIC fund invests in singularly is actually everything around life science, biotech. But of course, you're right, these are, let's call them startups or scale-ups, but still, it's not that level of investment. It's probably somewhere around 15 to maximum 30 million euro per company. And what really Europe needs is what you said, a much larger scale of investments to make this truly strategic. But to me, this is exactly the marriage with pension capital, because the situation that we have today is that taxpayers need to fund pensions, while such projects like the one you've described is one that will surely generate double-digit returns many years forward and can very well align with pension capital that needs to be patient. So I see this marriage as a perfect one, if only we can get the pension sector to believe in private markets, in innovation, and in breakthrough projects like the one you mentioned.
Let me just make sure we have time to continue. Do we have Okay, so there's a well-known lack of uniformity across the continent in a legal sense. Does Europe's regulatory diversity actually strengthen investment choice, or does the fragmentation undermine confidence compared with more unified investment environments like the US, for example?
Well, this is a topic that we've also been discussing a lot in Brussels, and the Capital Markets Union ideas have been around for more than 10 years and not yet put in place, unfortunately. There is still hope. There is a new project called EU Inc., which is now being heavily pushed, called the 28th regime, which would allow startups to be set up in the same way and allowed to benefit, for example, from the problems of ESOP programs and taxation of those and many, many things that would allow investors from all over, not just Europe, but all over globally, to have a very clear policy and regulatory framework on how these companies are to operate. I think the biggest challenge really from a fragmentation standpoint is liquidity. Right now, NASDAQ is bigger than the sum of all European stock exchanges. And so the real issue we need to solve is for that. Of course, there is fragmentation, but fragmentation can be seen in some ways as something interesting, and there are places where it becomes more competitive to be fragmented. In the end, what investors truly want is liquidity. They want a return of capital. They want to reinvest. And this is where we need to all come together to solve for the fragmentation challenge.
You know, last week, one of my administrative staff bring me the paper on the table. And I saw what's that, and apparently it was the rules how we can give champagne away to the clients or whatever. I said, had you nothing to do better than to prepare those rules? He said, that's very important. So that me reminds a bit of European Union. With the age, I have less and less firm opinions about the matters, but there is one thing where my opinion becomes stronger and stronger, and that regulatory regime in EU. And I might be not popular here, but I believe the damage we create through that regulatory regime for economies is really huge. And of course, we have to compare with US regulatory regime all the time. It's not like each state in US has the same regulatory regime, and professor can tell the obstacles he is facing in one of the states of US if he's willing so. But, the decision regarding how the corks should be put into the bottle of water, it reminds me the rules about giving away the champagne. We have so many more important matters to do in EU, and the bureaucratical apparatus of EU somehow needs to be directed to the better way to make those things happening for the economic growth, not against.
So I could tell that we like to complain where we live. And we live in Europe, we complain on Europe. So really, I live in two countries, a little in the United States, a little in Europe. And I could tell that in both this big, how to tell, conglomerates like the European Union and United States, it's a many issue on regulations. The same in the United States, and the same in Europe. But all of us, we understand that more regulations, less risk, yeah? But more regulations, less speed. So to find a balance between regulations and these two issues, it's not easy. But I agree with Rolandas, sometimes if to regulate too much, it's not help too much. But anyway, everywhere we could find some what it could be better, and hope it will happen.
I think we have enough time yet to take a couple of questions from the audience. So we'll start with the audience here in the room as the last time, and then turn to the participants online. And again, please state your name and your affiliation, and if you have a question directed at a particular person, let us know. And a microphone will be brought to you if you're in the room. Please speak up, please use the microphone so that the online participants can hear you clearly. Are there any questions? There's one.
Hello, my name is Stefan Gistmeier. I'm an economist here at the bank. And I have a question for all the members of the panel. And since I'm a macroeconomist, I think more about business cycle and even long-term growth. So I'm not in the investment sphere, but I'm very interested to hear what you have to say. And you mentioned it with one word in the beginning, that you see one of the big issues, and I'm thinking about this quite a bit recently, is demographics. And we're talking about confidence, long-run returns on investments. So by no means this is a Lithuanian-specific issue, right? But I would be interested to hear how you think about it, how you take it into consideration. When you have visitors from abroad that want to invest into Lithuania, do they talk about this? Are they interested? In general, it's just like a very open question in your specific fields of expertise. I would be interested to hear your opinion. Thank you.
Yeah, so it's a really good question, and with upcoming AI technologies, we think some of the problems will be solved with new kind of working. But demography is really important topic for us. But when we speak with investors, they actually are looking for the for the picture which is right now, right? How many talents do we have in one sector? How many IT specialists do we have? How many will we prepare in the next few years? We're not talking about the decades. We're not talking about the 50 years from now. But yes, we lost few projects that were looking to employ at least 1,000 IT specialists right now, because the market was too small for them. Talent market was too small. There was a Poland or Romania who has this talent, and they can employ them straight away. So it is very important for us to show that there are some laws, that enforce this demographic things, and also there are some programs already established that invites our diaspora to come back to Lithuania, also invite foreign people to come and work in Lithuania. So, for example, we have a unit at Invest Lithuania called Work in Lithuania that helps foreign or local companies to bring talent from abroad. So we solve this issue kind of, for now, in this way.
Well, we had 3.8 million people back in 1990. Probably we have around 2.9 million today. And is that the most happy thing that happened to us? No. And joining EU, which had very good benefit sides for us, had this negative side. So many people left looking for the better life. Now they can find this better life here. I have 4 children, and hopefully all my 4 children would be here. Also, my daughter spent 5 years at Accenture in London. But finally she decided, well, it's much more fun to be in the country where Lithuanians are number 16, the most happy people in the world, and the youth is number 1. Doing better than Finns. Some not so positive people say that those people under 20 are the most happy because they do nothing. So that makes them really encouraging. But we need to do something about it. Could we do much? I don't know. But if you do nothing, that would not be helpful. And there are like 3 directions which we can go. The one direction encourage more children, and government has the financial tools always to work with that. And probably that the most direct way, because educating society might take the tens or hundreds of years. That many more children is a good thing, not a bad thing. So the financial tools, that's one thing. The second, the government talks a lot about returning people from the foreign countries, and that's the good exercise to do, but again, it has the ceiling. There is no way you would attract all of them back. Although, you know, I see the people coming back. And the third tool, the most controversial, are the foreign people. And here it's very diverse opinions. Well, I would love, it's not nice to say, but I would love that all 80,000 Ukrainians would stay here after the war, because we need them. And, you know, I was giving this example before the war started, comparing ourselves with Poland. Poland is exactly 13 times bigger in population than Lithuania. But before war, Poland was attracting 130 times more Ukrainian employees in the Polish market. And that shows completely different attitude, you know, what Poles, for example, think and what we do. So we need to have some good balance, whom we want to attract, how we attract. Of course, the best would be to attract the talents, but that probably would not be sufficient to pay the pensions, you know, in 20 or 30 years. So we need to have the smart, clever system whom we want to attract. And in my view, well, I do not want to be in politics right now, but in my view, the Lithuania looks too little to Latin America. There are a lot of cultural similarities with Lithuania, maybe except the language, but we can learn it. They can learn Lithuania, and we have more interactions. So the more government would go that direction and more would think, the better result we would achieve.
I have some note because it was a discussion about confidence. What I wrote, I would like to read. So my understanding that capital follow confidence. Confidence comes from competence. And competence means good science, strong institutions, talented people, and clear long-term plan. So my understanding today was our discussion about it. And if to answer your question, I am quite sure that we should change our mentality and not to have, like we have today, 1 or 2 children, but more nations start to be more rich. More nations understood that biggest asset, it's not houses, factories, facilities, but most biggest asset, it is your children. And it will come. It will take a little time, maybe 1 decade or 2 decades, but it will arrive. And I am quite sure that in Lithuania, like my friend, he have 4 children. So really, he is one of good example how you know how to move, to which direction we should move. If we will understand that biggest asset is children, we will do it. Thank you.
I suspect we're running out of time. So in that case, that brings us to the end of the second panel. And I'd like to say thank you very much to all our panelists. I guess that brings us to the end of the conference as well. So thank you very much.